Welcome to this week's live ASX strategy session. Thanks for joining me for another show. Heaps of stuff to go through today. Lots of action in the stock markets, in the commodity markets, and also any stock codes you'd like me to have a look at. Get those codes ready. We'll go through those in the second half of the show. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get into this week's first chart. And starting off with the ASX 200. Well, after 3 weeks of persistent selling, the ASX 200 has had a rebound this week. But will the rally last, or is more selling coming? I'll talk more about this in a minute. And then over in the US, the S&P 500 has set up a cascading pattern. What does that mean? I'll show you what that all means in a moment. But before we do that, let's start with this latest price action in the ASX 200. Well, the last few days have provided a reprieve from really that relentless selling we had over the previous 3 weeks. And this allows for a bit of an emotional reset after a rough losing streak. And I think that's important, as it helps us reassess our situation without the stress of ongoing losses, of ongoing selling. And if we can do that, then I think we can be better prepared for what might be coming next. So where to from here? Well, last week we spoke about the fast move from above the moving averages down to below the averages. And when you get these rapid adjustments, they often go too far and you get a snapback in the opposite direction. And well, that's what we saw on Monday. We saw that snapback towards the moving averages. But how sustainable is this rally? How sustainable is this rally likely to be? Well, the key to forming a lasting low is an initial rally that then leads to follow through buying. So you can get a big up day like we had this week, and that's all a good start. But unless you get that additional buying following through, well, it doesn't mean all that much. So let's look closely at this week's price action. I'll just expand this chart out a bit so we can see it. So looking at this week closely, you can see the big up day there on Monday. Then there's a pullback on Tuesday, an attempt to rally on Wednesday that wasn't able to get back to Monday's high, and then selling again on Thursday, and then on Friday at around just after 1, it's sort of like in the middle of the range. So what we got from that, so far there's been no follow-through buying, and it appears that the rallies are attracting selling. So that's not what a lasting low tends to look like. And just so you know, the chart which I'm using, which I use every week for that matter, it includes the overnight trading from the futures market. So the daily bars will be a little bit different than if you're looking at an ASX 200 chart, which just has the day session in it. So just keep that in mind if you're looking at the ASX 200 day chart, and it looks a little bit different. That's why this has got the overnight action in it. And I think that overnight price action makes up an important part of the data. So that's why I show a chart that includes it. So getting back to this latest price action. Last week we talked about the next rebound, how the next rebound could help us identify what might come next. And just assessing, so if we're just assessing what we have so far, I don't think the selling is finished. As it stands, we have a consolidation which is below declining moving averages. And as we've just discussed, the dip has not been decisively bought. Now, of course, that can change, but that's so far what we currently have. Coming over to the equal weight. So let's look at the ASX 200 on an equal weight basis. And the selling has been heavier when we look at it on an equal weight. So while the ASX 200 has been down by about 10%, so from the highs to the current lows, the ASX 200 is down about 10%. The equal weights been off as much as 16%. And the reason the ASX 200 has been holding up better is largely due to the banks. But when you weight every stock equally, you can see there's been a lot more damage done overall to the market by this selling. There's been a reasonable rebound this week. So from the lows, this week has had a reasonable rebound in the equal weight. But like I said with the ASX 200, there's just not enough here to indicate that a lasting low is in. At the moment, this is a bounce within a sell-off. There's the sell-off. We have a bounce, and this is currently within the framework of that sell-off. It doesn't appear to be a turning point at this stage. For a turning point, as we discussed, we need to see those follow-through buying days, not selling of the rally, which is currently what it appears to be. One thing worth noting is that the equal weight is stretched below its 50-day moving average. So these are the moving averages. The blue's 100, the red's the 50-day, and prices have been particularly stretched and remain stretched below the moving averages now. So I think it's cause for not shifting to maximum pessimism. So yes, it's been rough, and yes, we don't have a rebound with follow-through buying, but I don't think that means that it should now be okay, shift to the worst-case scenario, maximum pessimism. Let me put on an indicator which will help explain where I am with this. So this indicator shows a percentage either above or below the 50-day moving average the market is. So if we can just compress this and get some more data, and let me just highlight this area here, and you'll see that where prices currently are, much of the time it tends not to stray too much further away from the 50-day moving average. See this blue range, or these previous occasions. COVID was a clear exception to that, but most of the time it tends to not get much more below the 50-day moving average than it was on Monday. That doesn't mean the market can't keep declining and prices can't stay below the moving averages for an extended period of time. Like you can see during this period here back in 2018, prices were stretched and prices did continue to decline. But it gets to a point where it's at a stretch level, and then you get the snapback. And there's a number of snapbacks along that period there. So these extreme readings tend to quickly snap back. We've already seen that this week. So I think it's another reason to try avoid getting caught up in panic selling. It's selling when you need to, selling when it's planned and is structured, but it's not just selling during panic moments, because the panic moments tend to take this indicator to its extremes, where the snapbacks then follow. Coming back to the ASX 200 for a moment, I've got to say we're living through one of the highest degrees of market uncertainty that I've ever experienced in my 30 plus years in the markets. Rather than trying to guess what's going to happen next, I think it's a time to continue following a good plan and really to act systematically, not emotionally. I know it's hard to do that sometimes, but I think that's the best way to get through these periods. Trying to keep it as systematic as possible and keeping that emotion as much to the side as we can. Maintaining discipline is how I believe we get through this type of period. I've been selling stocks that have hit their exit levels over the last 2-3 weeks, and I'll continue to do that. But as I've told you in the past, my selling has been planned. It hasn't been emotional and hasn't been based on fear. I'll also continue holding stocks that haven't given me any reason to sell yet. So just a pullback on its own isn't a reason to sell. It needs to come back to a structured exit point. And until that, I'll keep holding a stock. I don't want to sell just because it's unpleasant, just because it's uncomfortable. I want to sell because my rules tell me to sell. And I think it's that keeping that discipline, which, as I say, it helps us get through these periods with much of our capital still intact. Now, I'm going to do the US market now. If you're getting some value from this, please hit that like button, leave a comment, tell me what you think. Is this rebound going to last, or are we heading back down to the lows? But yeah, look, please hit that like button. It really helps me heaps, because YouTube then shows other people that you're engaging and you're watching, and YouTube shows others, and it makes the whole thing work for me. So please click that like button. Now, let's go over to the S&P 500. Now, the S&P 500's price structure has continued to deteriorate through the week, and on Thursday, prices closed at their lowest level in over 5 months. So around 5.5 months. You've got to come back over here to somewhere around September last year to find a similar closing point. My biggest concern is that every attempt to rally is being sold. Just look at the latest price action. So if we go back to, like, let's look at it from last Thursday. So last Thursday there was an attempt to rally, and then it was sold. It was sold the next day. Then on Monday there was another attempt to rally, and again it was sold the next day. And then the same pattern occurred on Wednesday, a rally which was then, and here we are on Thursday, sold the next day. Also note that when there has been a rally, the index has been sold into the close. So for example, I just expand this so you can see it. Like look at a Monday. Prices opened, rallied strongly, came back and closed at the lower end of the range. The same things happened on several other occasions too. So we have a situation where buyers are on the back foot and the selling is dominating. What we need to see is, as I was saying with the ASX 200, we need to see follow-through buying. We need to see prices closing near their highs. But what we currently have and what we're currently getting is the opposite to that. You'll also see that the recent rallies have been shallow. So like look at this rally from a couple of weeks ago, a shallow rally and then a sell-off. Now again, we've had another shallow rally and prices are down on their lows again. So that's another sign of selling pressure. And also the series of lower lows and lower highs continues to build. And that's been going on now for a good couple of months. What we have here, what we have in this structure, it's what I call a cascading structure. So let me explain what it is. That's where the declines tend to get sharper, but the rallies remain weak. You can see the weak rallies. You can see the increasing intensity. Or you can see, going back further, you can see the increasing intensity in the selling, but the rallies remain lackluster. And when you get that, the risk of a sharp drop significantly increases. So it gets to the point where the market completes. So you can see the sellers, you can see the buyers are on the back foot. They keep losing their footing and slipping back. And the cascading pattern, ultimately you can get to the point where the buyers completely lose control and you do get the sharp down movement. Not to say that's going to happen, but that's the risk. That's the risk when I see this pattern developing. I sold the second half of my S&P 500 holding today. It was an ASX listed ETF for the S&P 500. I bought the position back in April. It was back in late April when we had clear signs of follow through buying, the sort of buying that I'm looking for now. We had the follow through buying, and that's when I bought that position. We talked about it at the time. I sold. You might remember I also told you I sold half of that position in early February. Where was it? I think might have been. Yeah, I think it was somewhere in early February. I sold half the position. That was a big reason for that was due to the strength of the Aussie dollar, which was eroding the value of the S&P 500 position in local currency. So I sold half of it, then sold the other half today. So I'll move all those funds will now sit in cash until the price action improves and a new potentially profitable setup emerges. So I'll wait for the good setup to come to me and let the market do what it does in the interim. Coming over to the Nasdaq, looking at the Nasdaq as well, and well, The Nasdaq is again, it's weak at price action again this week. So prices broke down last week. Prices broke down from this 6-week trading range last week. Had a breakdown during the week. We had a consolidation near that breakdown point, which you often get when prices break out of a range. They then hang around that breakout point for a little bit. And then on Thursday we had selling, which has taken out the initial low. We have a new low in the Nasdaq for this round of selling. Downside risk remains high, and I think more selling is likely. The moving averages are crossing. They're crossing in a negative position, and prices are breaking down after several months. We can really say several months of sideways trading for the Nasdaq. Prices are now breaking down and also breaking out of this smaller pattern which we've been talking about. So it's I think it's notable price action. When prices break out of ranges, it typically sets off the next round of meaningful momentum. So I think the odds here favour that this has further to go. And the leading indicator for this move that we've been watching has been the Magnificent 7 ETF. MAGS. It's an ETF with Nvidia and Apple and Microsoft and Amazon and the like, all wrapped up in it. 7 of those big tech stocks are in this ETF, and so from its consolidation below declining moving averages a few weeks back, we had an initial breakdown, and then we've got another breakdown now. So it's declining lows, declining moving averages, consolidations below the moving averages. This is a weak structure, and I think the downside risk is high. Yeah, I said, we talked last week. I said, look, if I was holding this, I'd want to be out of it, and that's very much the same now. Not a dip I'm interested in looking to try to buy. I want to see strong upside first. I want to see follow through buying. That's not what we have at the moment. We've got follow through selling. I want to show you just quickly 2 more things I'm watching in the US market. First up, the 10-year bond yield. And this has been, let me just compress this a bit. This has been range bound for 2.5 years. It's just been oscillating either side of the moving averages for 2.5 years. And it continues to do so. We don't have a breakout in this at this point. But the risk I think the risk is that the current environment may actually lead to a breakout in yield. Prices are now becoming established above the moving averages. See, the moving averages are crossing and turning to the upside. This has happened before and we haven't had a breakout, so it may not happen now. But every time it crosses, we've got to be, and markets are on edge in all sorts of ways at the moment. So it's a sort of thing I think we need to be considering and being aware of. We also had this false break to the downside a few weeks ago. Prices got below these previous lows, wasn't able to extend on that, and has quickly snapped back to the other side of the moving averages. If prices can hold on to these recent gains, you can see this is a yield on the right-hand side, the yield increasing. If they can hold on to these recent gains and then they become more established above the moving averages, which in turn potentially sets up a platform for higher long-term rates, which probably isn't a helpful thing for either the economy or the stock market. You'll see this blue horizontal line I've got on the chart. If you're wondering what that is, I just quickly put this onto a weekly chart so you can see. And so this goes back, to the 1980s. But this blue line, it's just a fraction below 5%. You can see there's been an area of meaningful technical activity going back into the late 1990s, or you could even say the early 1990s. I guess we could just bring that across, thereabouts. It's and this is where we are now. The market's been just locked below there for 2.5 years. I'm not suggesting a breakout is going to happen, but I'm very mindful that at some point this range bound period is going to end. Which way is it going to break? Up or down? Up probably isn't going to be a good thing, but we need to see where it goes. And the other thing is this indicator here. It's the percentage of S&P 500 stocks above their 100-day moving average. And it's fallen, so it won't come as a surprise that there are fewer stocks above their 100-day moving average now than there were a couple of weeks ago. So recently it was up at, say, around 68% of stocks above their 100-day moving average. Recently it got down to 32% of stocks above the 100-day moving average, currently at 37. So as I say, no great surprise there. But it's we just compress this a bit. It's not loading up the rest of the data at this point. But if we compress this a bit, we're a long way from what I'd call washout levels. Washout levels are really when you get less than 10% of stocks above their 100-day moving average. Now, this doesn't necessarily have to come back to washout levels before you get a low. Marcus, this indicator does come back, it bottoms and goes up again. The extremes aren't always hit, but it shows. I think it does show the potential. It does show the potential for this to get worse. So sentiment is already getting pretty fearful, but stocks haven't sold off anywhere near to an extreme. So again, it doesn't mean it's got to happen. Stocks don't have to get this extremely oversold, but this is what washout levels look like down here. We're still well above that. So as I said earlier, this is one of the most uncertain times I've ever experienced in the market. I've been systematically de-risking as the price action has developed, and that's what I'll continue to do. It's not about being 100% right. It's not about selling at the top. It's not about buying at the bottom. It's not about being able to be smarter than everyone else. It's a sliding scale. It's a sliding scale from fully invested to 100% cash. And that slider continues to move towards a more defensive position. And that's the way I've been playing it. That's the way I'll continue to do so. So, okay, so we're going to jump over to the US small caps now. We've got the Aussie small caps to go through, the commodities, your stock code, so heaps more stuff to look at. But of course, that wraps up the free section. If you're not a strategy session member, there's a link below. Click that, come on board. We're going to go through a lot of things which I think might be of a lot of interest and of use to you. So think about paying the small amount of money it is to come on board and get involved in all of that. So okay, so let's start off. Let's go over to the US small caps first, and we'll start with the Russell.